Welcome back to the show, Total Financial Solutions, Safer Money Hour. Arif, Halaby, and Jeff Girard talking about your family's finances. Getting out of debt, of course, managing money and planning for your future. That's what Total Financial Solutions, Safer Money Hour is all about. Look, we're getting into a little bit of the 401k world, and there's some strategies and things that people can do that can really assist you in building up, in most people's case, the main part of your retirement plan, because frankly, today there isn't very many options that or companies that have the option of a retirement plan, of a pension plan. So 401k has been adopted, and we are seeing some options. Well, Principal Financial is kind enough to send Dan Mohr. Dan, tell us just some brief what Principal Financial is, because some people haven't heard of them, which is surprising to me.
Yeah, thanks. Well, we're a publicly traded Fortune 500 company based in Des Moines, Iowa. And I say that because we have Midwestern values, and it really does it's contagious across the company, even though we have field people throughout the entire country. And 95% of our assets under management are in retirement plans. So, most of our competitors have a 401k department because they're a big asset manager or they're a big insurance company. We're a retirement plan company, so it allows us to focus entirely on the retirement plan, which is a 401k experience of the business owner and the employees. And we work strictly with advisors. So if anybody would ever be interested in learning more about us, they could connect with their local financial advisor, you of course as well, and find out more information about Principal.
Principal Financial, if I'm a small business owner, I have 1 or 2 or 3 employees, does Principal Financial provide a solution, a retirement plan solution for that company?
We do. Yeah, we'll do a 401k for, if you don't have a 401k at work and you like to start one up, we're one of the few companies that will do a startup 401k plan for your company. And we have over $100 billion plus plans that we account for. So we really span the whole spectrum of different asset sizes and different businesses.
So that's important, guys. If you have a small business and you're earning money and it's time to start setting aside for your retirement, and that's one of the objectives usually, Principal Financial offers small business retirement accounts. We can help you with that. There are others that are out there that certainly can. And what is the cost? If I'm a small business owner, I want to set up a plan, just roughly. I know it's a little bit broad, but what does it cost to set one of these up?
Yeah, to set one up, it's generally between $1,000 and $2,000. But the great thing about that is that the government is really providing maximum incentives to have a 401k plan. So if you don't have a plan today, you get a $500 a year tax credit for 3 years that can minimize those expenses, and the expenses towards the 401k are tax deductible. So it can be under $1,000 after that same type of 401k plan that a Fortune 500 company would have, a local company could have for under $1,000 after all the tax incentives.
And every year, is there a fee to maintain it?
Yeah, it's an ongoing fee, and the 401k is an ongoing process. It's not a transactional type of sale. It's an employee who might put their money away for 20 or 30 years. So it's a consistently recurring charge, but it's for maintaining the websites, having statements go out, providing education, and enhancing technology that participants really seem to take advantage of.
And we're seeing that small businesses all the way up to 10, 20, 30, 100 employees sometimes are missing that little component because either they don't understand it, they're afraid of it, or in fact, they're just trying to pay their bills and keep the lights on. And now they're there. Now they've settled in. They've got their business off the ground. 3, 5 years have passed, 10 years, whatever it is. It's never too late to start one of these. Is that
No,
right?
It's never too late. And maybe 5 years ago, cost might have been an issue, but the market has gotten more efficient, more advanced technology, and costs have come way down. So if it was something that was explored 5 years ago, it'd be a tremendously different price difference now. And some business owners have a concern about their fiduciary liability, and that's an important concept to understand. When you take on a 401k plan, you become a fiduciary if you're the business owner.
And let's explain, what that is, because Dan, that's a very hot topic these days. Mm-hmm. That means that you are financially, legally responsible to make the right decision for the employees. That's in their best interest, not in your best interest as the employer. That can be scary. Your job is to make widgets or to be a mechanic or to be a baker. And now, goodness, you've got to be an expert in retirement plans or health insurance, or people say just forget it. Well, in this particular case, Principal and even Total Financial Solutions, we have a solution to that.
That's right. And we partner up together to really take, there's a rule that's allowed. Nobody expects the business owner to actually be the expert on the 401k. So it's called the prudent person rule. And you're allowed to hire someone to be the expert. And so as the business owner, you hire a really great financial advisor, and you get a good partner on the provider side, which would be like Principal. And that minimizes your fiduciary liability. It never goes away completely. And so long as you're always acting in the best interest of your employees, you'll always be safe.
Yeah, if there's fraud involved or if there's purposeful manipulation of things, certainly nothing is going to get you off the hook of that. And you know better, even when you're doing those things, guys. So you stay out of trouble there. But so it's really simplified over the years.
That's right.
There's not really a big deal in the world of cost. That's kind of come down significantly. Now, Jeff, tell me about this 1% rule, because we have seen this. In fact, we just did this, I think, today for one of our companies, and that's the next step that we're doing as well.
Well, usually the 1% has a kind of a negative little stigma to it. But when we're talking about your 401k plan, it's the idea that every single year that you're participating in this plan, you increase your contributions by 1%. Now, let's just say you start out your plan, and I think we should get into what this percentage is. Let's say you start out at a 3% contribution. That means, and just for simple math here, if you earn $100,000 in a year salary, and you take 3% of that, that's $3,000. If you break that down monthly or biweekly, then you arrive at the number every time you get a paycheck that you would put money in. So that percentage sounds pretty easy, but in dollars, it gets a little bit more detailed there. So that said, this year you start with a 3% contribution. Next year, you would be deferring 4%, and then the next year 5%, the next year 6%. And so what it does is that it's giving you an automatic increase every single year. And the nice part is you don't have to manage that. Isn't that right, Dan? You can elect to have that increase automatically every year.
That's right. It needs to be a provision of the actual 401k plan. So if it's not one, you should ask for it. It's maybe the single most important thing you can do in your 401k. People get very fixated on, where should I invest my money? And that's important. I don't want to minimize that. But the single greatest impact on whether someone's going to have enough money at retirement is their savings rate, how much money they're putting away today. And if you can get up to, and I don't want to scare anybody, but if you can get up to 10 to 15% of your income, that's going to be a really good number. But if you're sticking at 3% for 20 years, it's just not going to be enough, and we know that.
Yeah, one of the things that I really appreciate is there are strategies. It's what I did when I was 18 years old and I started saving. And there's strategies that we've spoken about is every time you receive a pay raise, every time you receive a bonus, you lived yesterday without it. Take it and put it back into the retirement accounts. It's how I bought a house at 23 years old. It's how I was able to have a lot of money saved in my 20s, was because every time I received a pay raise, I would put money into my retirement or savings or investment accounts. That is an important part.
It's the philosophy of pay yourself first. And if people can really embrace that, and look, 1% a year on pre-income tax, you don't feel that.
No.
We've had people respond to us and say, I didn't even realize I was in this program. And now that I'm in it, I'm so thankful that I am, because I look at my account balance and it's bigger than I thought it could ever be.
Yeah. Often we say, look, Jeff, we have seen this with clients. They bought a house in 1975 and they bought it for $47,000.
That's right.
We could barely survive. That payment was tough. It was $300 a month, and we didn't know if we could do it. Well, fast forward now, 20, 30, 40 years later, that payment's a piece of cake. So inflation can kick in, and it usually plateaus and then spikes, plateaus and spikes. A lot of us are of the mind that there is a potential spike in inflation coming around the corner, and when that does, your savings rate needs to be in line with those dollars that you need to spend 10 or 15 or 20 years from now.
I think it's a big deal to remember, and Dan, you're talking about that scary number of 10 or 15%. and I haven't said this for a while, but if you could defer 10% of your income now and have it replace 100% of your income later, wouldn't you take a 10-to-1 ratio? I mean, think about this for a minute. You're going to live on 90% of what you earn to live on 100% of that later. I mean, it's got to kick in somewhere, because this is your money. It has to go in. It has to come from you. It's not going to come from air. That's a big deal if you think about how much of your retirement life is going to depend on that small fraction you're giving up now.
And the beauty of the 401k is that because it's pre-income tax, you're giving up 10%, but it's only going to feel like 6 or 7 because it's pre-income tax. So you're not paying taxes on that amount. So the impact on you is even less. And so if you could get to 10%, you're doing yourself a real favor. And look, we're all victims of inertia, where we just kind of go along the path we're on sometimes, and in the 401k it can be especially true. So these automatic features that do it for you every year without thinking about it, you increase a percent. You don't go flip a switch. You don't have to go in line and do anything. It's an automated feature. If you can get into that, you're going to be very, very thankful to your younger self when you go to retire.
And tell me about a matching program, because people hear, oh, it's matching. What does that mean, matching?
So matching is an incentive that the employer will give to the employees to get into the 401k plan, and also to give them a little bit of extra money to help them get to retirement. A match is, if you put money in your own retirement plan, your employer will match a portion of that and put it in there. And look, it's often said, and it's true, for the participant or the employee, it's free money.
It is free. And here's one of the things where I'm going with that is, you're going to put in 10% of your money.
It's a great point.
And then you're going to feel like, let's say 6. But your employer is going to match, let's say 2. Maybe a lot more, but let's just say 2. That means you now have 12% going in. So if you earn $1,000, you have $120 sitting in your account, but it only costs you $60 out of your pocket.
That's right.
Isn't that amazing?
Nice.
You always have to take advantage of the matching. It's free money. I don't care what you say or do. I don't care if you have to, eat noodles and bean burritos. It doesn't matter. Start up to the matching and then increase it 1% every year. That's really the key, you guys. It did it for me. It's done it for everybody that we've spoken to over the years that have taken our advice in this area. This June will be 20 years in this business. I can tell you I've seen that as an enormous difference.
Well,
Jeff?
that's right. And I say, to your point, the 1% rule, the saving a bonus at any type of you get a pay raise, putting that extra money in there, that is really the component, because we have to really have you focus on the contribution. Now, something else I think that comes into play here is, and 401ks have a lot of rules, a lot of bells and whistles in there, a lot of moving parts. A vesting schedule, Dan, that's a big part of it too, because going in, getting some of that free money that we're talking about, could I participate for a couple of years and then walk away with everything that I put in and what the employer gave me? No, they want to kind of put some handcuffs on us, don't they?
Yeah, it's the vesting schedule would generally be put in place as a form of retention. The business owner says, I don't mind giving you 3% match, but I'm going to ask that you're here anywhere from 1 to 5 years to earn the entire match. The government has set up rules where you can't withhold the match from someone for too long. The maximum is about 5 years, and at that point, you're still going to get 80% of your money if you left.
I see.
It's called a graded vesting schedule. But the good news is, and this is really super important, is that as much as you want to take advantage of the match, and you do, the money you put in yourself is what we call always 100% vested to yourself. So that's your money. You never have to worry about a vesting schedule on your own money.
And plus what you've earned, the interest you've earned, everything. Yeah.
And you know what? One point about this is I happen to know the biggest fear people getting into the 401k. There's a reluctance because it's, I don't understand investments. I don't know how much I should put away. We can overcome that pretty easily. The biggest fear of putting money into a 401k is, I don't have access to that money until I'm 65. That's scary.
Right.
I'm already kind of living paycheck to paycheck, and I have to put money away that I don't have access to. So as a quick point I want to make is that you can have access to that money. There are provisions that allow you to have access, whether there can be a loan provision where you take a loan out of your own account and pay yourself back that money. We generally say that's great if there's an emergency, you really need it, and it could be available.
And the loan folks, most of you know this, but if you have a 401k and had to tap into it, they will tell you 50% or $50,000, meaning the most you can expect to get in a loan is $50,000. I don't care if you have $2 million in that account. However, that 50% rule can hit some of us. If you have $30,000 in your 401k, you can only borrow half of that, or $15,000. So just know what the numbers are, and it is not a put and take account.
It's not.
It's not your emergency savings. It's a last resort. I'm homeless, or I borrow. That's when you pull it out.
Yeah, and we don't encourage loans, but sometimes you just legitimately need your money.
Sure.
And people, I'd rather see someone get into the plan and know that they have access to their money if they really need it than to fear that and never get in.
Sure.
There's also the potential for hardship withdrawals. If something in your life really dramatic happens, that you can have, there's certain provisions that allow you to have access to your money. So it's not locked up forever. Don't let that be a fear, because there really are ways that you can get your money if you legitimately need it.
Yeah, we've covered in-service distributions and in-service rollovers, meaning depending on your age, when you hit that age and still employed, still receiving the matching, and you can take some of those other dollars out of the system and do other things with it. So there still is a lot more flexibility today than ever in accessing your money from the retirement accounts. Jeff, we've talked, and Dan, we've spoken of blackout periods before, Jeff, you and I on the air. Dan, give us an idea of what that blackout period is, because sometimes 401k companies will do a takeover plan. For example, your employer has a plan, they've had it for many years, they decided it's time to switch from company X over to principal, and they say, now we're going to make a change.
Yeah, that's right. It's really a safety net, safeguard, I should say, for the employee, the participant, so that during the stretch where there is a transition of assets from one provider to another, that you can't go in and change your accounts. It's really just mostly so that you can't change your investments. The money's still yours, it's still available, but it's kind of locked down until that transition is made. And that can be, it's generally called a 30-day blackout period, but I've yet to see one really go 30 days. It's just the transition from one company to the other. The investments get locked so the employees can't go in and change it. And then once it transfers over, it opens up again. And it's really just to protect the employees from anything happening when the transition occurs and being out of the market when the money's trying to go over.
And if you have any fear, guys, one of the strategies we say, listen, if you're not sure the new company or if the funds are going to be transferred from like to like, we say talk to your HR director or the company directly and just put it in a money market account. Write out the next 4 weeks, because sometimes it could take 3, 4, 5 weeks. Write out that period of time sitting in a money market account. Yes, you're not going to be earning big rates of return in that account if the market goes up, and you're not going to lose if it goes down. But for some of you, that peace of mind of just sitting on the sidelines until this, transition is all over, that can help.
Yeah, because I think what people would mostly fear in the access world is a big swing or a shift in the market, either up or down. Hey, if it's up, that's great. Everybody would be in favor of that. Give me more money. But if it's going down and they can't stop it or make those changes like we're talking about, then you might want to take some control ahead of that blackout period.
That's right.
So here's what I would focus on, guys. Over time, you're going to be wanting to say, I'm going to start this 401k next year. Well, no, you need to start right away. Oh, no, I'm going to start after the kids graduate or after the summer or after my next promotion. If you don't start something now, you probably never will. Where do you go? If there's a matching program, it's a no-brainer, as we say. You put in whatever that first percentage is. For example, company says we match, I guess it's the second percentage, however it works. We match 50% of the first 6%. Then you put in 6. We match 100% of 4%. Then you put in 4. Whatever number that they match, that's the minimum. That's the opening the door, free money. I'll give you an example. We had a gentleman who was my neighbor years ago who worked for the county. And he says, I invest on my own. And I said, do you understand they have today it's mandatory, but back then it wasn't. 7 years he'd been a county sheriff. He had never put money in their account. And the only way they gave you money is if you, in a matching program, is if you put money in. He never even opened the account. We did the math. Just the free money alone, forget the market growing or not growing, was $35,000. And that's money you cannot get back. It's gone, poof, forever.
Cannot get it back. That's the biggest point.
So keep in mind, guys, that's part of the objective. All right, so know your company's vesting schedule. That's the time that the money transitions over to you. There's usually 2 different types that I have found. One is called a waterfall vesting, which is nothing for 1 year, nothing for 2 years. And at the end of 3 years, 100% of it is all yours. Companies will do that if they have a business that is often a lot of turnover. So maybe a restaurant or a business that has a lot of young people that are just passing through. Well, they want to encourage you to save. And of course, when you leave, all of the money that you have put in is yours and the interest gone. But that vesting dollar figure, those dollars off to the side, if you left prior to, in this case, the waterfall vesting period, nothing. They take it back. Dan, where does that money go?
Well, it goes back to the company to be able to offset other expenses or to be able to offer match in the future.
So it can go to the other matching for the other employees.
Yep.
So you should be getting some sort of a thank you note, folks, if you quit and move on.
And Arif, the 1.2 is that, just to be clear, there's no such thing as a mandatory match, meaning that
Yes.
not all companies provide a match for their own reasons. Don't let that deter you from putting money away as well. If you have a match, you got to take advantage of it. But you are responsible for your own retirement in this day and age. And starting something and increasing 1% every year is a great strategy to get you to a more comfortable retirement.
And that's a great point that you're responsible for your own. I think the millennial group, basically, I did some research real quick, 1980 to about 81 to 2000, right in that period of time, that 18-year period of time. The group that is born in that window, and I guess all three of my children must be millennials because they're right in that area, you are pretty much an independent spirit. You're not really trusting. You have to verify everything through Google, whether or not it's Google is accurate or Wikipedia is accurate. One of my kids went through and said, take a look at this experiment, because they allow anybody to I guess that's the whole purpose of Wikipedia, to edit. So they went in and they did some gobbledygook and something and made up some stories. I don't know, maybe it's like unicorns and rainbows or something. And they changed this profile and nobody caught it for years. So in other words, I can say that almost any. So in other words, be careful if you trust something like Wikipedia. The old story that if it's online, it has to be true is pretty much a joke. So do your research, folks, but check with the experts. Check with the folks at your human resources, financial teams. Today there's podcasts. We have, I don't know, over 2,000 podcasts now available from Total Financial Solutions. The 12 years plus we've been on the air. You're going to hear what we think about things. You can hear how to contact us. Send us an email. We'll answer it on the air. That's what millennials, and I think, frankly, that's what everybody should be doing. Research and protecting your own accounts. We're going to be back in just a minute. I'm Arif Halaby, along with Jeff Girard. Total Financial Solutions Save for Money Hour special guest Dan Mohr from Principal Financial, the largest 401k company in the nation, probably the world, when we come right back. Total Financial Solutions Save for Money Hour on AM 1220 KHTS. Hey, welcome back to the show. Total Financial Solutions Safer Money Hour. Arif Halaby, along with Jeff Girard. And special guest, Dan Mohr from Principal Financial, one of the largest 401k providers in the world. And Principal Financial basically allows small businesses, large businesses, to get in there and start saving, preparing for retirement, because we know that the truth is you're going to have to take care of yourself in retirement. You're going to have to take care and manage and prepare for yourself. Other than that, you probably don't really have too many other options except maybe Social Security, if and when it will be there.
Or to go get a government job.
Gosh, I wish I could. Well, now they're paying government employees more than private sector, it seems, so there's not a change, really.
That's almost the only way to get a pension anymore. I mean, the numbers are kind of staggering. Out of the, 19% of employers have, so almost 1 in 5 have a pension, and
only 3% are
3%
private.
Are private companies.
Yeah.
That's incredible to me.
So a lot of this is going to have to be in your own hands, folks. One of the options that came up a few years ago to be added to your retirement account at work is something called a Roth, R-O-T-H, Roth 401k. Dan, tell us what a Roth 401k is.
Sure. The Roth provision on a 401k allows people to put away money post-tax. And that might sound a little strange. We've been advocating for pre-income tax savings. It's really a nice benefit. But for some people, they want to put their money away post-tax, pay their tax money today. But the upside is the trade-off, the positive trade-off is that when you go to retire, you don't owe any taxes at all. And so for a lot of people, that's very attractive. And the way I look at it as it's a good way I don't know if it's the right solution for each individual, but if someone's thinking about it, I would be more hesitant to consider it try to figure out what taxes are going to be down the road and look at it as more as a diversification strategy.
Yeah.
That's right.
So that you have some money that's post-tax savings today and that you're going to take out without paying any income tax, and some money that you'll pay income tax on. It's just a way to balance those buckets.
And you still have those same investment selections inside of the plan. You still have the same protection against bankruptcies and lawsuits,
right.
things like that. So all of that still stays inside the 401k wrapper.
Yep.
You're just not getting the tax deduction today.
Yeah, and some individuals cannot do a Roth IRA on their own because they make too much money. There are income limits on how much you make to be able to put money away into a Roth. But in the 401k provision, there is no income limit.
Nice.
So people that would otherwise be disqualified from saving in a Roth outside of work can actually save in one inside of work. And you don't have to put all your money into the Roth. You could split it up half and half. And just as a side note, any money that the employer gives you has to go in pre-income tax.
Yeah, so no matter what, if there's a matching plan, that goes into the regular 401k that we've been speaking about. The Roth is only possible for your contributions. This is a huge component because, as Dan was saying, to the diversification of income and taxes, not just where the money is sitting. So that in the future, if you say, I'm going to have some money pre-tax, some money post-tax, you can decide when to take out what, how to take it out. There are some rules that are associated that are worked more towards your benefit if you are in a scenario. Look, it has to still matter to you. I think you should sit down with a financial professional, come up with a strategy. Total Financial Solutions, we're available. You can come to us anytime you like. There's no fee. There's nothing like that type of a scenario. If we can help you, great. We get paid by the companies. That's what we do. But you're not going to write a check to come and see us.
The Roth part of this is really important, but Dan, we're seeing that there's a growing number of companies offering it, but I think I read somewhere recently that only 50%, about half of the employers out there that offer 401ks have the Roth provision as part of it. How hard is it to adopt that 401k Roth provision if you have an existing plan?
It's very easy, thankfully, and it's a good point that a lot of the things we're talking about when we say provisions, they are allowed by the IRS, they're allowed by the government to be on a 401k plan, but at the end of the day, the business owner makes the final decision on how that plan's created. So if you're an employee of the company and this is something that's attractive to you, it's okay to go and ask your employer if it's available, and if it's not, to ask if they can add it. Adding something like a Roth provision is extremely easy.
It should only be like a piece of paper or something, right? You send it to your service provider. If you're the employer, they can add it on there, and then poof, everybody's
Basically that simple.
able to do that. That's pretty nice.
You know, we'd like to see that you guys are setting up your retirement accounts, setting up a plan so that day to day you are moving towards whatever the financial freedom goals you have. Meaning, I want you to have various types of accounts, various lifestyle choices that you can make later on. If you say, I want to live by the beach, or I want to rent, or I want to buy a ranch, you can do all of those things, but preparing and planning today. Now, look, there's this balance. Living today, driving a nice car, living in a nice home, taking nice vacations. You know, I get it. There's a balance somewhere between saving for the future and saving now. Find the balance that's right for you. Everybody's a little different.
I would agree. And remembering that whatever money you're going to go without spending and having that go to your future, that's wonderful. But I've seen it both ways, where people will save nothing and spend everything. And some people that, make pretty decent livings, or at least on paper they do, and they live as though they're never going to see another paycheck again. So that balance, I think, is, it's different for everybody, but it's something that I think you should at least visit every once in a while.
Folks, we want to thank you for joining us this hour of the program. We've got a lot to cover here, and we try to do it in a short period of time. But go to hometownstation.com, click on Total Financial Solutions. You can find us there, and easily, folks, send us an email. The other thing I want you to watch out for is you can download the free KHTS app on your iPhone and Android devices. Now you can listen to KHTS and us, Total Financial Solutions, anywhere you go, wherever you are. I've done it when I was in Hawaii, driving in Maui, listening to my own show as Jeff was doing an awesome job carrying the program. You can access KHTS News wherever you are, social media, and a whole lot more. And the easiest way to go, of course, is To download the app is Google Play or the App Store and search for KHTS. Dan, thank you for coming on the show.
Thanks for having me. It was a pleasure.
You're welcome, and Jeff, thanks for joining us again.
Always, sir.
Every week at this time, folks. That's me, Arif Halaby, Total Financial Solutions Safer Money Hour on AM 1220 KHTS.